January, the 1 month rates have dropped in half from 0.06 to today 0.03. 2 months went from 0.07 to 0.02. We're starting to get into that realm here of possibly negative rates, which we saw, of course, briefly a year ago, March. Just want to get your thoughts on that. Is there any issues here of shortage of collateral? What's driving this as you're watching some of these short-term rates approaching zero?
So with T-bills in particular, this would really be a Treasury issue, but I would say, it's a lot of demand for short-term. There's a lot of liquidity, and people want to store it to some extent in T-bills, and there's demand, and therefore that drives down the rates that people are being paid or receiving for buying those assets. From our standpoint, we control our policy rate is the federal funds rate, and to the extent there were to be downward pressure on that because of, for example, the Treasury general account shrinking in size, then we have tools that we can use to to keep that rate in the policy in our intended policy range, and we will do that, and that should also limit the extent to which other money market instruments like T-bills would go even lower or perhaps negative.
So do you have a concern? I mean, I think many of us were surprised. We saw negative rates here a year ago. These rates are getting awfully low in the short term? Is it a concern of yours, Ben, or not?
Well, again, our principal concern is that the federal funds rate be in its intended range. It's the range intended by the Federal Open Market Committee. We also we do see that there's the possibility that other money market rates could move down, and I think to the extent we're able to keep the federal funds rate in its range, that should ameliorate some of that downward pressure, and that would be appropriate.
Kind of follow up on that same point, Mr. Chairman. The last couple of weeks, we have seen a lot of volatility, for example, in the Texas gas markets that to a degree spread out to other markets. If there were several of these other kind of special circumstances all happening at the same time, might this lead to a shortage of collateral in the form of T-bills, as seemed to be in the case that we saw here last March?
It's possible. I don't really see that happening, but it's true that there's tremendous demand, and again, the issue of supplying the demand across the curve is really one for the issuer, which is Treasury.
Is there any merit, or might it be a good idea to waive the supplementary leverage ratio for, say, a year until some of these special circumstances we're seeing regarding the recovery from the pandemic in the past, and when perhaps we will have less possible need for some of the dealer intermediation in the repo market and some of the other short-term markets?
As you, I'm sure, know, the temporary relief that we granted regarding the SLR expires at the end of March, and we're right in the middle of thinking about what to do about that. I haven't got any news for you on that today, but we do expect to make a decision on what to do about that exemption, that change we made to the SLR back last year.
Shift gears and looking at some of the prospects of these asset bubbles. We're seeing signs of speculation across various portions of the economy. Stocks, of course, trading at very high prices to earnings ratios. Ag commodities moving up. Economically sensitive materials such as copper, nickel, they're soaring. Bitcoin's up 80% this year alone. Mr. Chairman, how do we know when, I guess to quote, I think it was Mr. Greenspan, talked about irrational exuberance has unduly escalated asset values, which then might become subject to unexpected and perhaps prolonged contractions?
So as we look at those things that you cited, what many of them have in common is that they're related to expectations of and greater confidence in a stronger recovery. So that's the metals. It's not so much Bitcoin, but it's the metals that you mentioned, and inflation expectations and other securities prices are really related to, because of all the factors that are out there right now, an expectation that the recovery is going to be stronger, sooner, and more complete. And so that's okay. We saw, commodity prices moved up a lot in 2008 and 9, and people were worried about inflation. The inflation never came. So it's a healthy sign, I think, there. We're focused, honestly, on making sure that we're providing the support that the economy needs to get back to maximum employment and stable prices. We've still got 10 million people fewer working now, according to the payroll statistics. And it's much worse than that among the workers in the lower quartile. So that's really our focus. Our focus in financial stability generally has been to have, a banking system and financial sector that is highly resilient to shocks. I'm
going to change the order of this.
All right, Mr. Chairman, I'm over my time at the moment, so thank you. Yield back.
Thank you, Senator Daines.